So in this point, at this time, you didn't really anticipate that formula, I think, that was going to be used to arrive at such high tariffs. Kind of maybe got blindsided by that to some extent. But with that in mind, you still think we're starting to see signs of a Trump put as of yesterday? Maybe the NASDAQ closing higher is an indication?
Yes, that's right. Markets are stretched to the downside because we lost, almost 13 percentage points in 2 trading days. As you know, it's almost like the stock market and the economy was delivered a heart attack from the terms of those tariffs. So I think that there is a bounce underway. Mark Newton, our head of technical strategy, views this as a technical rally. I think something that can take us, to recover towards 5,500 or something like that. But I do think that there is, the challenge is going to be, we don't have a fundamental clarity and sort of the all clear enough for us to say that that's going to push us back towards new highs. So I do think we're kind of stuck in the near term, but yeah, I think markets overreacted to the downside. And yesterday, it does look like the messaging has switched. The president has moved towards to letting people know they're negotiating. And I think that's a return, or a quiet return, of the Trump put, because I don't think they want markets to continue to have this heart attack.
So you many times talk about your technical analysts, and a lot of times that doesn't involve trying to gauge what's going to happen with fundamentals or certainly not policies. But in this case, you got blindsided a little bit by something totally unexpected in your view for the size of the tariffs or the level of the tariffs. Why do you feel confident that we're in negotiation phase now, and tomorrow we might be back out of negotiation phase? You could get blindsided again, Tom, and then that would throw off your 5,500 target, wouldn't it?
Joe, that's right. One of the things, we spent a lot of time talking to investors between Wednesday, Liberation Day, and over the weekend. And, it's clear to us investors feel that not only were these tariff levels absurd in the sense that it was very difficult for people to understand the calculation, but it really did break a covenant with capitalism. The idea that businesses need stable and predictable regulations. Many companies moved their supply chains in 2018 because of the need to move away from China. And now they have, potentially trillions of dollars of stranded capital, again, because of these tariffs.
Exciting news flashes across the stock market landscape, shaking the foundations of investor expectations. Tom Lee, the renowned and typically optimistic head of research for Fundstrat Global Advisors, found himself in a rare moment of miscalculation when faced with the unexpected terms of Tariff Liberation Day. Welcome back, everyone, to Investocracy.
I think that's the seismic shock that's very tough for markets, and the trust that's been broken. It doesn't mean that we can't see a level of clarity that helps restore that trust. And so markets, after this waterfall decline, one scenario is a V-shaped bounce that takes us back to the previous levels. But the reality is it's going to, I don't know what that sort of clarity that's required for that is. So I think it does feel like this will take some time. And one very good friend of mine is Tom DeMark, and he says this reminds him of 2011. I think that's not a bad way to look at it, that it's going to take a little time for markets to regain some trust.
But we did see, Tom, that huge roar back yesterday on the false rumor that suggested that they were going to pause, the administration would pause for 90 days while doing this. So the market may have broken trust, but it's very eager and really hoping, it sounds like, for some relief to come from this.
Yeah, I think so. I think that there maybe were some, that's almost, if that was a trial balloon, it worked. It showed that if there was conciliatory actions that were sort of friendly to businesses, that the market could have a massive, massive move. The idea of like an exporter tax credit, these things really can restore confidence, because at the end of the day, the entity caught in the middle of this has been companies and the capital that they've invested they need to earn a return. That hurts shareholders, but it also hurts all the employees that work at these businesses. So I do think that the ripple effects, looking back, it does make sense why the market had a heart attack. But of course, this also means parts of this is very fixable, but it does mean that there's, a bit of time involved.
Amidst this whirlwind of economic uncertainty, Tom Lee's reassurance gleams like a beacon. Even in the face of adversity, Lee maintains his glass-half-full perspective. One can't help but wonder, though, if the market's resilience will hold in the wake of such regulatory turbulence. Let's pause for a stock market joke. Why did the investor bring string to the stock market? Because they wanted to tie up their portfolio. But before going on with the video, are you into cryptocurrency? If so, check out our second channel, Investocracy Crypto. We bring you breaking news, expert analysis, and the latest trends in the fast-moving world of digital assets. Whether you're a seasoned crypto investor or just curious about the future of finance, we've got something for you. Click the link in the description to subscribe to Investocracy Crypto now. Don't miss out and stay ahead of the game. Now, let's get back to the video.
So it's your largest tech holding, correct?
That is correct.
Along with, a number of these other mega caps, Microsoft and Meta, Nvidia, Amazon, Alphabet.
Yeah.
I mean, those 6 stocks are your largest holdings out of your top 10.
Yeah.
Where are these things going from here?
Look, tech has led the downturn, right? And we've seen a lot of degrossing activity in the tech space. But you have to look at where valuations were and where valuations are now today. So tech has been about a 20% premium to the S&P 500 over a very, very long period of time. At the top, and when the enthusiasm around AI really got going, we were at about a 30% premium. Right now, we're at a 7% premium. So this is the lowest premium that tech has seen in a long time. And if you step back and say, okay, look at the fundamentals around who can actually drive resilient business models in a tariff type environment, it is the tech stocks, right? And you have to think about it as they have more pricing, they have more competitive moats, so they do have a little bit more pricing power. They do have cleaner balance sheets to be able to invest counter-cyclically, and they do have higher gross margins, right? And so I do think tech is going to be much more resilient. I think the earnings estimates for broader tech are going to hang in there a little bit more than people expect. And with the valuations being at a discount, we do think it's a good opportunity on a relative.
The current scenario echoes a perplexing blend of fear and hope. Predictability hangs in the balance, entangled in the shifting winds of global policy changes. With each tweet, each proclamation from the White House, the market bristles with anticipation, waiting for the next twist in this intriguing tale of economic fortunes. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
If the economic picture darkens and we rethink earnings numbers more broadly, and we decide that the overall multiple of the market needs to come much lower, then suddenly what is a 7% premium, even if it holds, is lower than it is now. That's one of the problems.
So the market is basically telling you that the earnings estimate revisions in tech are going to be worse than what they see in the rest of the market. And we just don't fundamentally believe that that's going to be the case, right? The starting point around gross margins is much higher. They have more pricing power. They have the balance sheet to be able to flex. And they have durable growth characteristics like AI. And so we do think that the earnings power is going to likely be much more resilient for tech. And so we do think that that's what's creating an opportunity for investors to start reallocating to tech.
Are they recession-proof?
They're not recession-proof. Look, certainly, like these businesses are economically cyclical, just as everything else is. But we play in a relative world, right? And like I do think right now they have defensive characteristics, but they also have offensive characteristics. Think about that 1 hour where the market whipsawed up. What rallied were a lot of the AI-related names. So there is this pent-up demand to want to own tech. People are degrossing right now, and you can only degross what you own, right? And people own tech. And so we do think that there's a lot of technical forces that are at work as well that are driving some of this correction that's creating an opportunity.
As the stock market churns with the ripples of uncertainty, one glimmer cuts through the fog: the potential for de-escalation. Public figures like Lloyd Blankfein and Bill Ackman advocate for postponing reciprocal tariffs. Countries extend olive branches offering concessions, and President Trump himself voices reluctance towards triggering a market downturn. But what do you think? Share your thoughts down below. Finally, if you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.